We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Brics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. I hope you enjoy it and hope to see you on the next one.
Hey everyone, thanks for joining us this evening. You can always DM me or Bob if anybody has any questions, or we can maybe we can start with a couple. But we're going to get into inventories, LBMA and Comex, supply constraints, premiums. Obviously, put all that in the title, but I think it's good to do a couple more of these as we see the situation developing here, because we did another one last week, and to see, let's say, the changes week by week could become important, right?
Yeah, that's the part that the market's accelerating in terms of, the price is pulling back and metals are, on paper it's breaking down, but the demand story hasn't changed. And I think, was it the September numbers came out for India, which was just another barn burner, I guess. David will probably tell you too, this is a global story. This isn't just simply about the US and 1980 and us coming off the gold standard in 71, and we're seeing inflation in our country. I mean, this is a global phenomenon that you're seeing, and all this metal that's leaving from west to east, I guess you could say. You have this deleveraging that's happening, that's been ongoing since Basel III. That metal has been scooped up, for instance, by India, China, whoever it may be. But you're seeing a lot of flows going westbound, but you're also seeing a lot of buying here in the United States. Over the summer, Europe saw tremendous amount of buying, and these countries like Great Britain. I mean, my goodness, if they just, I think Truss's government, I think she may be kicked out here soon, or loss of confidence, whatever that means over there. But imagine you're a UK citizen and your pound starts dropping, going to parity against the dollar. What do you do? I mean, everyone's trying to protect what they've earned over the course of their life, and these currencies are really just the relief valve for all this debt that needs to be inflated away.
Mm-hmm. Funny you mentioned that, but I saw the other, somebody had posted a head of lettuce next to a picture of Liz Truss, and they were saying which one is, or they were going to say which one is going to last longer.
That's funny. Yeah, I tell you one thing, Twitter and these memes can be just brutal sometimes, especially if you're on the wrong side of it. But
absolutely. But is that maybe more symptomatic of these problems are starting to really show themselves in countries that are more affected by the strength of the dollar? I know I was just talking with Steve at SRSrocco report right before this, and we were talking about the fact that Zimbabwe is going to keep their interest rate pegged at 200%. And this seems just such a ridiculous notion. And then you see basically the peg for the Japanese yen breaking past 145. You see the pension markets in the UK starting to break down. Or are those signs of this debt system really starting to break apart?
Yeah, I mean, it's when you kick this can down the road for 20 or 40 years, I guess. I mean, you could go back to, did it start in the 70s or did it start in the 90s when long-term capital had its issues, and then you started to see the bailouts from there, or did it start from 1987 and then sort of the Greenspan era of, continually sort of support asset markets? The term PPT or plunge protection team comes to mind. Anyone trading in the 90s, maybe in the 2000s, that was a common term that was used because you'd see the markets do these enormous rebounds out of nowhere. No leveraged society can withstand a lot of economic pain, asset price pain, for an extended period of time. It's just that the way the tax structure is set up, the way the leverage system, the mortgage securities, 30-year mortgage, all that type of stuff, all that leverage needs constant increases in asset prices to stay alive. And that's where this idea of continually expanding the Fed's balance sheet and increasing base money and all those types of things, that's why I think what drives a lot of people to the metals over time as they see that's how the game is. It's a zero-sum game. And at the end of the day, either the U.S. can print enough money or the financial system can print enough money or expand the leverage enough to maintain asset prices, or like we're seeing now, the big danger is inflation has become the total Achilles heel of the system. And now just simply printing money or doing stimulus payments and that type of thing have a more negative effect and direct impact on people's cost of living. And that's where you're kind of now really stuck in this quandary of, do you bail out the markets before inflation is actually under control? And if they ultimately have to come in to help support the markets, or more importantly, support the U.S. Treasury market, because that's narrative of supporting the employment rate as well as inflation. Those are two mandates. Their biggest mandate is supporting the U.S. government. I mean, making sure that they're funded, because if the U.S. government bond market fails, you got some serious problems. And that's where you're seeing, sovereign yields. Everyone thought sovereign yields or sovereign government debt was 100% safe. What they didn't understand was the prices can still go down if interest rates go up, and they have gotten clobbered. And Yellen coming out on Friday talking about, maybe we should be buying some treasury debt back from the banks because the treasury is sitting on a lot of cash. Well, they obviously, a lot of them mark to market securities that are held for maturity. The accounting is basically, if it's held for available for sale, then they will mark to market. But you've had an enormous amount of buying by banks over the last few years supporting the treasury market. All this type of leverage is starting to show the cracks in the system. And the question is, how much more can they tighten the balance sheet up without really setting off almost like a nuclear bomb in the middle of the entire financial system? That's when you're looking at the markets, like our little sector in precious metals, the more this paper price drives down the price, it has second tier effects and tertiary effects where it's hammering the mining companies that are on the edge of, maybe they're close to the cost of production, or maybe now they're below the cost of production, or maybe they just don't see the incentive of opening up a mine and maybe mothballing something that they were going to start. But that starts to hamper supply. And I think that's where the derivatives is having a true impact on an industry itself. And that's where I think LBMA came out a couple of days ago and talked about how they were going to start doing more support for artisanal miners, smaller artisanal miners that maybe can add metal to or supply into the LBMA refining stream, so to speak. They're seeing maybe that, hey, supply is really becoming an issue here, and the refiners are all, if they're, and I've been telling this since August, is that refiners are pulling metal off these exchanges because they need a source of metal. They need consistency because they got clients and customers that want physical product. Those customers care about rolling a forward contract another 3 months. They need to make a product so they can stay alive and pay their bills. And that's what we're starting to see this impact of, is this backwardation is a symptom and a sign of physical metal is in true demand. No one really cares about 3 months from now, especially with inflation really not coming under control yet. I mean, it's still high, and of course the Fed, their interest rate hikes and I should say their balance sheet reduction and tightness of liquidity is going to have an impact, next year in the economy. But the issue is you still have high costs of living, high costs of operating businesses, high cost for mining, pulling metal out of the ground. But they's mines they're just getting hammered because their underlying commodities priced in dollars, and they're just not seeing the return they're having to pay the costs to pull that out of the ground with. That's the struggle I think we're seeing in the industry, and how that correlates to us as investors opens up a whole new can of worms that I've been trying to track for the last 2-3 weeks, talking to different players out there. I would imagine you're going to start seeing them having to try to slow this freight train down of metal leaving. I mean, you're below 39 million ounces of metal in the Comex at this point, to 38,134,000 in registered.
Silver or gold?
Silver. Yeah, silver. You just had you just had another 645,000 leave today. That's metal that's leaving. It's not just simply going to the eligible category. It's being delevered. It's it's maybe being held, maybe tried to held for purposes of maybe being put back onto the registered category again at some point in time. And it's just kind of mothballed collecting dust. No, this is metal that's being moved because it can be sourced. Stuff that's in the eligible category is stuff that's going to basically sit there and collect dust. It's more longer term, non-levered, non-financialized, non-collateral metal. That's the traditional eligible category. And it's metal that it's not held via warrant. With the registered category, the metal is held under the clearing firms, whereas the eligible is going to be held directly by the investor or an ETF or some type of institution, but it's held directly for their name in most cases. And so it's not something that's simply going to be financialized very quickly onto the market. Whereas in London is more designed for physical metal being leased and loaned and repoed and that type of thing. There's more financing activities involved in London. And I think that's, part of that was born from the unallocated account system that they have over there. But of course, that unallocated account system has become somewhat problematic because it's a high cost of doing business now because of the Basel III initiative. So all these things have impacts. And what that means for us as investors is the market's getting tighter. The lower the price goes down, the more metal, physical metal is being bought. The more guys like me are saying, hey, listen, if the coin market's totally out of hand at this point, the bar market's going up, every day or every other day in terms of premiums. At some point, the 1,000-ounce bar makes a lot more sense, and I'm just going to buy that. And so you get a lot of people that starts buying more 1,000-ounce bars. That's the bar that's in demand by institutions and fabricators and refiners and industrial applications and things like that. It puts a demand on a particular product that's used by almost everybody in the industry. And then that's where you're going to see effect on true price, because people will want to buy that 1,000-ounce bar and they'll start paying a higher price for it. And it obviously starts moving the price of the metal. And that's the interesting thing, though, is that this massive move of inventory coming out of the market, this deleveraging, is going to start impacting trading flows. You're seeing, I talked about open interest declining, falling like a rock. All these things are going to impact next year. If trading volumes start to die down or players leave the market, how does a wholesaler or a trading desk hedge if they don't have the open interest in the Comex because there's no metal left? I mean, if the metal continues to draw down to a dangerous point, and David can talk about that, his thoughts on how low that metal can go before maybe things get stressed. You're going to see more volatility, lack of liquidity, and less participants. It's going to be just like the palladium market. Now, this is what we were talking about after the Basel III had been passed. Again, June, we had that call with a few different people on your show. You're going to start seeing a lot more volatility. I think that the precious metals, when this move finishes here, I don't know if it's going to be a washout, some capitulation, but when these shorts finally start to try and cover and there's and the open interest is collapsing, I don't know how they're going to get out of their contracts, without, some type of violent move to the upside.
I'd love to hear your thoughts on this as well, David. And maybe we can add a little bit where, Bob, you were talking about what maybe the Comex could do to stem that flow of metal out of it, and how they could go about that.
Well, they could raise margins. I mean, the typical thing that Comex will do, especially if the market gets very volatile or choppy or gets too one-sided, is they'll raise margins so that they can try and stem the volatility and try to protect the integrity of the market. The problem is this isn't a margin-driven event. This is a cash-driven delevering event that's simply saying, hey, listen, we want the metal that's there. You don't see open interest 180,000 contracts on silver. You see it at 120,000 contracts. It's been dropping all year. It's been dropping ever since COVID happened in March of 2020. Open interest has died. You've seen a lot of hedging activity go to London because a lot of these OTC transactions are a little bit cheaper to do than on New York. These are the effects of, for one, when you take interest rates to zero and you made lease rates negative and everybody just started piling on gold, leasing it, and then using gold as a carry trade. You saw a lot of metal come onto the Comex in 2020, and that was one of the reasons why. Well, when interest rates have been rising and lease rates have been rising, all that metal now is flowing back to the bullion dealers or to refiners, and a lot of that's just going to the east now. It's just being bought. And so the market is delevering. This isn't something that raising margin rates will have any impact, especially if they raise margin rates and the market's short. That'll affect the short players as well. So I don't know how, unless the Comex just makes it maybe a little bit more difficult or influential in terms of saying to clearing firms, let's, make it a little bit harder to maybe, take delivery. With premiums going up the way it is, how much harder can they make it? They're the cheapest game in town, like Jim Hunter says. I mean, it's the best price metal out there. You just got to go through the process of standing for delivery, and that's the tricky part, is standing for that delivery. But that's the issue that we're running into, and that's where, if you look at like London, for example, London silver inventories, gold hasn't really changed much. But if you look at London, it's gone from, 1.1 billion ounces a few months ago to now it's 860, or was it 871 million ounces last reported. I mean, that's now below the 2016 numbers when they started to actually count inventories on the LBMA. This is the reality of the physical precious metals market versus the sort of structured and influential paper market that's really being traded on a day-to-day basis, whether it be for spreads, whether it be for secular direction, or for basically for price representation. You're seeing a market that's starting to wake up here that could really have a pretty dynamic effect on the underlying price, where paper products, which had a dominant role before, may turn out to may accentuate the move, I should say. I don't know if David wants to mention anything.
I'd like to pop in a couple things. As we get started, I just looked at the Commitment of Traders report as of October 11th, and the commercials are now net short, as they almost always are. They're net short 60 million ounces, which is not very big for them. And then on the other side, most of it is the non-commercials we refer to as the trading funds, and they are net long about 7 million ounces. And then the public makes up the difference. So there's a match, as everybody knows, or most people know that study the silver market or the commodities market. For every long, there's a short, and every short, there's a long. The setup I'm seeing is just to confirm what Bob's saying, which doesn't need any confirmation. We know Bob's got it together, but the open interest is really pitifully small. So what this tells me is that the people that are in the know, that play in the derivatives market in silver, have exited. Now, not all of them. Obviously, there's 125,000 open interest right now, but that's low compared to what it's been in the past. So a lot of people that are smart enough to see what's coming have probably exited and aren't going to reappear. The other part I wanted to talk about is what happened in the palladium market. I actually was in the palladium market when this took place. And what happened was Ford Motor Company wanted physical palladium, but no one told them how tight that market was or how small that market was. They had changed their assembly line to go from platinum, which was more expensive at the time, palladium, which is far cheaper at the time, in their line for catalytic converters. So the logistics guy, the buyer for Ford, called up and said, I want this much palladium. Well, guess what, folks? There wasn't that much palladium available. So what happened was they raised margins across the board. Well, I was long, and I thought, well, I may even add a couple contracts. But no, long or short didn't matter. So that started to quell the market immediately. But the market kept going higher and higher because Ford was taking delivery. Believe it or not, at the top of the market in palladium, during that instance, you had to put up twice the price of physical palladium to hold a paper contract. Do you hear what I just said? The paper market was so distorted that you had to put up double the cash price to hold a paper contract. So the LME basically took over the whole thing, and they basically said who got the palladium, when, and how it was leased out and everything else. So they basically took total control of it, which isn't in their mandate at all, but similar to what happened in nickel. So I gave that story to illustrate that these rules are only as good as they're followed, and they're not followed that well when push comes to shove. Now, what could the Comex do? Well, one, they could admit they've got a problem. And if I was in charge, I'd say you immediately have to balance the system, which means you cannot have more of a derivative than exists available for delivery times maybe some modest factor, like let's say 1.2, 20% or 1.5 perhaps. But that's not the way it's set up. And because the derivative is what sets the price and not the physical metal, we're seeing the distortions that Bob's already outlined. I don't want to repeat everything he said. It all makes perfect sense and it's all valid. But we're seeing what I've never basically seen in most of my life. And I've been around a long time. And that is the commercial bars have got a pretty healthy premium on them. And as Bob said, that if that's the only silver you can get, you're going to get it. And the Comex has always been the provider of last resort. No one ever takes it. I've got a couple anecdotal stories I won't tell because I want to stay on point. So I just made a few notes. I want to check them. And the eligible, as Bob says, down to 38 million. I've watched it go down to the 30 million ounce registered number a couple of times in the last 20 something years. And I sat at my desk here, rubbing my hands, going, okay, this is it. We're getting really close. It can't go much lower than this. And it didn't. But what happened was instead of a price explosion, which is what I expected, we got a very large bunch of silver that came into the warehouses. Where it came from, why it took it, that long, why it had to get to that number, I can't explain it. I don't know. But again, I've seen it at this level before, actually lower a couple of times. And again, both times I thought that was it. This time it's different. Why? Because in those two other instances, there was no huge premium in the retail market. There was no premium in the wholesale market. And there wasn't all the problems that we're having now. I mean, people are paying extreme prices, not only for physical product, especially on the retail side, but for delivery, to take it, to get it fast, to get it like, day after tomorrow type of thing. So this market has been distorted for a long time, but it's more distorted now than I've seen in my entire lifetime. And we all know I've been, looking at this market my entire life, really. I don't know, Tom, I might have brought up a few questions for you. That's the notes I made. I wanted to get out there for everybody's, so everyone can pontificate on it if they wish.
Mm-hmm. Well, I appreciate that, David, and I always appreciate your contribution here. Maybe we can start with getting a little bit more about maybe where possible supplies of other, like let's say other supplies of metal could come from at this point to help stem this flow of metal, or if the refiners need it that bad, refiners making product because they can't necessarily source it elsewhere. Like you see, in some ways, the Comex has become the supplier of last resort. Is that true in this market where industrials are starting, let's say industrials, for example, are starting to only source it from the exchange rather than refiners or producers?
Yeah, pretty much. I mean, obviously, they're going to take it from wherever they can get it. And they can't get it their normal supply chain. They're going to go to another one. And the last one normally is the Comex. I wasn't going to share this anecdote with you, but I will. When Phillips Baker took over as CEO from Mr. Art Brown at Hecla, I met Phil. In fact, Art invited me over to meet him. And shortly thereafter, Phil put together, I'll call it a mini silver summit. And he had everybody invited. I mean, he had myself, CPM Group, the CFTC, the CME, the Silver Users Association that were around at the time, a lot of the other mining companies, mostly here in the area, the Silver Valley, and other places. So the only one that talked about silver as money was me. I was kind of the odd man out. Everybody else was talking about it. The Silver Institute was there about it being an industrial metal, and that was about as far as it went. So the guy from the CFTC was kind of on the panel. I was in the audience this time. I wasn't, up front anymore. And I asked him what would happen if I set up a fund and I started to take silver off the Comex at the authorized limit at that time, it was 1,500 contracts or 7.5 million ounces. And he said, well, you wouldn't do that. And I said, well, why wouldn't I do that? He goes, you would never buy it off the Comex. You'd go off, from a refiner or somewhere else. You wouldn't buy it off the Comex. I said, well, humor me. Let me say that I'm going to, take it from the Comex. What would happen? He never gave me an answer, by the way. I also pressed him on the Hunt situation, and he said they never changed the rules. They just did what they had. Now, I've gone back and forth with that, and I don't want to go down that rabbit hole. But the only way this thing could be solved is so simple. Let the price run. But the way the derivatives market is so structured, there's so many bets. It's sort of like the Big Short. What we don't talk about too much is what are the bets in the over-the-counter market we can't see. That's one big factor. And it's probably a lot more metal on paper there than there is what we can see in the LBMA and the CME. And then what we don't know is what the options market looks like, particularly in the OTC, because it's like this Big Short. And what I want to get to is like the CDO squared. I mean, you've got a bet on top of a bet on top of a bet. So you've got a lot of counterparty risk. And the way out for the CFTC, for the CME is that we could settle in cash, and they will. The problem is once they do that, then all credibility for them being the supplier of last resort goes out the window. And I don't think they want that. I'm composing my own letter to them. Ted, who's been probably the most notable as far as looking at the commitment of traders, bar none. I don't think anybody in the world has done it to the level that Ted Butler has. That's about all he looks at, in my opinion. And he's knowledgeable as hell. I give him credit as being the authority on it. But nonetheless, you can look at these numbers all day, and it doesn't change anything unless they have a corrective action, which would mean, as I stated earlier, to put in a balance, meaning that you can only have the amount of contracts that's reasonable versus what the physical inventory is. And of course, if that weren't the case, going back 30, 40 years, you'd have a whole different silver market than you have today. But that's one way to do it. So if we let the price find its equilibrium, then let's, for a thought experiment, say that silver goes to $50 in 3 weeks. There'll be a lot of people that bought it at 30 that just couldn't take the stress of watching it go from, 32 when they bought it at 26 and watching it go down to 18 in the paper markets, and then seeing it's actually at 50 across the board, very small premiums again, that wouldn't get out. And that would reliquefy the market from the physical standpoint. The problem I see, and I'm going to keep talking until you cut me off, is we're at what Rafi Farber calls the end game. And that is what we know for the bigger picture. And that was that the Bank of the UK, the Londoners, basically were at a point where they had to intervene in the market, or the whole pension system was probably within hours of being annihilated. And so they took whatever action was necessary to overcome the outlook of what they saw and establish ordinary market conditions, which they have not reestablished. And no one says it better, in my opinion, than von Mises. And he says this is precisely the quandary described as the endpoint of all credit bubbles. There's no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion. So you don't allow it to expand, you stop it, which the Fed's claiming they're going to do. Or later, as a final and total catastrophe of the currency system involved. In other words, printing money until no one ever wants it again. And that's the path we're basically on, which means there's the possibility, I need to get this out, Tom, and thanks. There's a possibility that the $50 silver is meaningless because most of the silver stackers know that it isn't worth any amount of paper at some point. Now, I don't think we're going to see that. I think there'll be, people that would sell at that, take the paper or whatever. But my point being is that the big picture is very bleak. We are near the end, and something's got to give. And what we don't know is which way it's going. we've written about, my thoughts on it, and many others, of what the banking establishment wants to reestablish their control under a new system. I have little doubt that's what they want, but whether or not that's able to be implemented remains to be determined.
Thanks for that, David. And I think one of the first questions that pops to mind here is, as you're talking about, like you said, hypothetically, if the price goes 50, what does the premium situation look like that at that time? And would your average investor that bought, maybe a monster box or 100 ounces or something like that, maples, would they end up being able to recover even a portion of their premium at that point?
Probably not. I mean, in my hypothetical, and you could take it any direction you want, Tom, at that price of hypothetical 50, premiums came back to normal. So you're looking at, $3 over or something for a silver round rather than what they are now. But still, that'd be the sell price. So you would get, let's say, $50 for something. Let's say you bought Eagles today at 36. You'd probably get 50 and some kind of premium on an Eagle. But I think that's what would take place. I think you'd see the premium shrink once the price was moved into an equilibrium basis. I have little hope, really, that this thing is going to function correctly, if I can use that word. I think it's broken already. And now we're just going to have to witness how much more broken it gets. It's unfortunate, but what's going on at the LBMA, as Bob outlined, and what's going on at the CME combined, and I forget the gentleman's name, you probably know it, that does the great work there on Twitter showing us what the offtakes have been. I mean, this trend is very well established and it's not going away. In fact, it's increasing. And Bob will tell you that these wholesalers cannot really cover their positions with the way that the futures market is set up now, because we're in backwardation and they need metal. They got to have it and sell it to, as you feed their kids. This isn't going to stop. That's why I've always said, and many, many others, that the physical market will take command at some point. It's just the CFTC, in my opinion, has just been so stupid for so long to allow these entities to go beyond the position limits that are established by the exchange that they never enforce. And here we are, and my letter that I'm writing right now says, hey, why don't you go back to the rule book, read your own rules, and enforce them? But anyway, I'm done.
Well, David, something I'd like to get your opinion on as well is why, I don't know if you heard, but Bob had brought up the point that we've almost never seen demand like this, let's say out of India. Why is it that they seem to understand that? Is that just a cultural thing that they understand that metal is a store of value? Is it a gift over there? How do they view it, and what makes the demand so large over there?
Yeah, it's cultural. And up until the China boom, there wasn't that much gold. Gold was always popular in India, but it became more and more popular as it became more and more wealthy. The reason, and this give credit to Angelo, because I don't do this all by myself anymore. Thank you, everybody that's in the silver movement, I'll call it. But he pointed out that I think it was in 2020, the price of silver and rupees was at an all-time high, and they had COVID. And what are you going to do? Well, if their culture is save in silver, we don't trust government money, and that's the culture, and you have all this silver, what are you going to do? You're going to sell silver, especially at an all-time high, take the rupees and put dinner on the table. So we had a mass amount of transfer coming out of India in 2020. Now the reverse is taking place, where the Indian population is taking silver hand over fist. So yes, it's cultural. It's actually more popular than gold, or has been for decades. Gold became, I'll say, more popular as they expanded their credit system, but now it's coming back to silver.
Interesting. Bob, do you have anything to add there to what David highlighted?
You did a great job. What I would say, because I get more into just the structural markets, I try to stay more on the black and white of what's actually happening. What does it mean for clients? What does it mean for investors? When you run a hedge fund and you run a depository, you're really trying to say, you're trying to stay sort of tunnel vision to what's actually going to happen on the money side of things. And what I've been counseling people for a long time was that, try not to pay a lot of money for premium on your product purchase, because I think David's right. When the price does go back up, and there's going to be a magic number, whether it's 35 or 40, whatever that number may be, that will bring a lot of secondary selling onto the market. And that secondary selling is what we have not seen the last 2 years. It's just been basically, 90% of the transactions are probably been buys, 10% have been sellbacks to the industry, but it's been very one-sided. And I don't, David could tell you, I mean, when we went to 1980 and silver went to 50, I mean, the refiners were David could probably tell you the exact numbers, but they were buying, junk silver at a discount, like a $13 discount to spot at the time, because they were actually pricing things 4, 6 weeks, 8 weeks out, because they were that backed up trying to melt all this metal. Those are things to be careful about, and dealers won't tell you that. And it's something that I've been, I get a lot of bad rap for it in terms of, oh, you're just banging on the dealers. It's not necessarily banging on the dealers. It's trying to do what's right as an industry for a consumer that wants to buy a product from that industry, but they're buying it for the reason of trying to protect their purchasing power or their wealth. They're not doing it so they can just simply, it's not like a collector's item that they're just going to put in the sock drawer or put on a mantle. This is really an investment for a lot of people, and it's their retirement, it's their life savings. And why should you be paying right now 100% premium for a silver eagle? It makes absolutely no sense unless you're just trying to bet that the premium is going to go higher at this point. And people may not understand, but 2023, when January rolls around, there's going to be a lot of silver eagles coming back onto the market that are 2023s. I mean, this is what I try to help people understand is, again, when you're trying to buy metals, look at the premium structure, because there is a spread risk that you could run into where you buy too high of a price and then the price goes up, but then the premium drops. You could be breaking even, on 100% move in the market, and that's not going to help anybody's financial position. So those are the things. I mean, that's just part of it. But again, if you start to see more volatility, which I think when we do start to get this move higher, it's going to be wrapped with volatility. I mean, Bitcoin was a great example. I mean, David could probably tell you all the volatility moves that happened when silver moved in 1980 and when it moved in 2011, and it will definitely jerk you all over the place. But that's symptomatic. It's just like the nickel market, watching that thing go up. I mean, it didn't just go up on a 45-degree angle. I mean, it just went up straight up like a hockey stick. It just hit that certain point of price where shorts just basically get stuck. And I think the same thing is going to happen here. I just don't know how the hedging market will work in that environment, because that's where the wholesalers and retailers are going to have probably a more difficult time providing bids, meaning if the spreads are wider, not just the premium on the product, but the spread between the bid and offer widen out. The consumer may not understand that as well. David can kind of talk about, especially with palladium, how wide those spreads are. But there's multiple things that could start impacting the markets on the way up. It may not affect the price, but it may affect the product that you own. And that's, again, what you try to, as a fiduciary, I don't really look at myself as a dealer, even though I buy and sell metals. I look at myself more as a purchaser representative. I try to help the individual understand all the risks associated with getting into the metals, and then therefore try to create the best experience possible at the end of the day. Not try to say, hey, listen, you got to buy the Eagle because it's the greatest product in the world, and you're going to pay up, a massive premium for it, because you could have just bought 1,000-ounce bars and pocketed, 60% more metal or whatever it may be. You want to try and put the client in a position to basically be in front of any event that could take hold and try to profit from that event, not get harmed by it. So
maybe if you could, guys, explain to us a situation where if we see, for example, silver go over $50, what kind of a situation would we need for premiums to stay high at that point? Would it just be that secondary supply not coming onto the market at that point?
Yeah, I'll speak to it. First, I'll give you real life, and then I'll try and answer your question, Tom. So when silver hit 50, I was in the LA area, and there were some major retail dealers all through LA, but mainly on Sepulveda Boulevard. And there was a big lineup, as everyone has heard annually, that people holding silver candlesticks and, junk bags and bars and everything else. And every dealer in LA, to my knowledge, bid back to 35. So if you walked in, even though the paper price was 50 in plain view, you were going to accept 35 from the dealer or not. You could, walk away. Lots of deals were done on the street, probably at a higher price than that. But the dealers themselves basically I don't know if they colluded or not. I think they did. That's my opinion. But they were only paying 35. So what would it take for the premium to remain high? It's supply and demand. It would be at $50. I don't trust the paper market anymore. I think it's going to fail within the next couple of months. Therefore, I'm not selling it for 50. But if you give me a premium of 70, of $20 on my $50 paper price, I'll probably take that because I want to convert that $70 silver to pay off my car loan or, pay a debt or buy a house or whatever they're going to do with it. And knowing, and this is my hypothetical, that paper market's still valid for another couple of months, but they're going to make a transaction like the next day type of thing. I'm exaggerating for effect, but that's what the meaning is, that I don't trust the paper market holding much longer. I want a premium. You give me that premium, I'm going to take it and I'm going to use it immediately. That's how I see it, Tom. You probably ought to bring Steve in and, Bob, whoever else wants to come. I mean, I pretty much, I'm going to hang on. I'm going to hang in here as long as I can tonight. But, I think I've said my piece.
We also have Steve from SRSrocco report. And maybe, Steve, you can talk to a little bit about what David and I were talking about a little bit before, was the demand from India and what you saw there. I know you charted it out quite well.
Yeah, thanks, Tom. It's good to see you, Dave and Bob. It does seem it's a huge change compared to what it was last year. And I imagine Dave probably spoke about this already. Basically, India flatlined. They were importing 15 metric tons of silver or 20 metric tons of silver a month for like 7 months. And normally their average tends to be 400 to 500 metric tons a month. And so now towards the end of last year, the Indian silver giant woke back up, and they have considerably in the last several months. And I think in just 2 of the last 3 months, it's close to 1,700 metric tons. And so now I was looking at the numbers. It's like 7,500 metric tons already. I think the record is 2015, over about 8,000 tons, and they still have 3 months left. And this is their busiest. Their ceremony, a lot of weddings take place. So this is the busiest time of year for India to be also purchasing silver. So they tend to take advantage of low prices, which they are. And so now I think in looking at the Metals Focus, their India charts, they're showing that a lot of this silver is coming from London. And so I think this is part of the reason we're seeing a drawdown in some of the inventories at the LBMA. And so India's become a very big buyer of silver. And I think that's going to continue. And again, you get more strong hands come into the market. There just isn't the supply. And so, I heard Bob, I stepped out for a minute, but I heard Bob in the beginning talk about the mine supply. So you've got falling mine supply. You've got increased demand, a lot of it coming from India, more industrial demand, a lot of investment demand, even demand overall. And we're not getting enough mine supply. And so it's starting to be pulled out of the places where the exchanges and the ETFs, and even David talked about the similar thing was happening with palladium and Ford. I think we're heading into a perfect storm with silver in the coming months and quarters and years ahead.
That's actually something that I wanted you to add there, Steve. Is I know you recently posted an article on your website about mine supply was projected to grow for 2022, but yet it has declined. So why is that?
A lot of it has stemmed from Peru. And we knew that Peru was going to decline in production because one of their larger mines, the Uchuchacua mine, they shut that down at the fourth quarter of 2021. And the reasons why they shut this down was due to, it was Buenaventura's mine. There's two big producers in Peru, it's Buenaventura and Hochschild. And their Hochschild is actually headquartered in London. They shut down this mine because the economics were poor. And so what they've done is they've been doing some more exploration. And they said they're not going to bring this mine back online until at least the fourth quarter of 2023. So Peru is already down. They're down 9% compared to last year. And Peru, I put a chart on Twitter. Peru peaked at 155 million ounces. I believe it was 2017. They started to decline in 18. They started to decline again by 19. They were down 20 million ounces. The pandemic really hurt them. And because of a lot of these smaller third world countries, the inflation is really hurting them. And that's why the economics, even Hochschild mining, I looked at their first half of their production. It's a little bit lower and they're barely breaking even. And so what you're seeing from the second largest silver producer in the world, Peru, right behind Mexico, their peak production was 155 million ounces. Now it's going to be probably maybe 100 million ounces. It was 110 last year. This year, they may get 100, maybe below that. And then also Chile, the Metals Focus was suggesting that Chile was going to increase production. Chile's not. Chile's production has declined. And another big player is Australia. They're number 4. Australia is right behind China. They're number 4. They are down 18% from the same period last year. So when you add this all up, we're seeing falling mine supply, and we're getting into a perfect storm now with all these problems we're seeing in the financial market and the bond market and the Japanese yen and the British pound. And so I think silver investors are looking, the price right now doesn't really show the problems that are coming, why investors are going to move into silver. So yes, we're seeing, I think the number was supposed to be 843 million ounces. That's what we were supposed to hit this year, up 20 million ounces from last year. I think it's going to be 810 or less. It's going to be a decline, and maybe even more of a decline next year if we continue to see the problems with the global supply chain.
Well, between the supply chain and rising costs for the miners, right? You and I literally just finished up an interview right before this about how really the energy that these miners use to get this metal out of the ground is really starting to affect them as well.
Yeah. Well, I was going to add to Steve's point on the energy side. You also have what's going on in Europe. You have the energy to actually refine the product as well, not just to mine it. And that's causing issues and delays and added costs that are coming. And some of these premiums that you're seeing that are being hiked on the wholesale level and then hiked on the retail level to make up for the wholesale hikes. Those wholesalers are seeing their hikes right from the refiner or the mint, and that mint is seeing, for example, if it's a say the U.S. mint, for example, is just an example. The blank manufacturer is probably increasing the cost to make the blank, but they're also they're seeing the premium for the shot or the bar to pick that up is actually increasing as well. So you're seeing this whole food chain just start to rise, kind of like the tide. Ultimately, it comes down to the consumer and how much they want to pay for it. But the price is so low right now that I think it's easier to basically say, hey, listen, I'll pay a higher premium because silver historically is very cheap relative to maybe the S&P 500 or to the other assets, or you look at the gold silver ratio. Problem I see that the consumer has been, the story that they've been provided, and a lot of times was really the last couple of years was to pad the profit margin of the industry. Now you're starting to see the industry costs are starting to rise. And I think you may see the mints that make these sovereign products are probably going to start increasing their prices. And yes, the industry is still going to make a fortune, but it's going to make a little bit less, and it cause probably more tightness and availability, especially in the smaller tier gold dealers. They may have a harder time getting available product because there's just less product to be made. And that's why, again, that's why you see the LBMA pushing this narrative of, hey, let's get involved and help the little guy, the small artesian miner, basically left out of the business. They've had to sell their ore to sharks almost to try and get that ore through the entire system, to have it sourced properly. And whereas the bigger miner has an easier order flow. Well, what's happening is I think these mints are also catching on to their authorized participants. The authorized participants are sort of acting as almost like ticket scalpers now. The mint, who's the band, they usually get their cost or whatever that costs to produce and make their little profit. They're starting to see, hey, listen, our product's actually worth a lot more. So you may see also mints and refiners upping their product costs to the wholesalers, knowing that, hey, listen, we want a little bit more part of this action, and that's ultimately that will start hurting the market. Right now, the problem is that the market's overloaded to one side of the boat, whether it's been on the short side or it's selling, capitulation, whatever you want to call it. You're seeing this sort of washout develop in the precious metals world. And you're seeing, especially with miners, people that own mining stocks, and everyone that's in the mining industry knows that the cost of capital is starting to go up because interest rates are rising, and you have higher energy prices. I mean, there is a huge amount of headwinds that have impacted the mining companies that doesn't get talked about enough, I think, on YouTube and on Twitter and all that type of stuff, even from the promoters out there that try to push mining stocks. They don't. There could be better education on it. That's why I kind of followed David Morgan's advice right from when I first started following him back in 2003, was physical metal should be the core part of your portfolio. And talking to when I started getting into the metals in the mid 2000s and talking to Jim Rogers, I had a conversation with him, and he was telling me that the average stock in an industry does just as well as the underlying commodity itself. So the question is, do you just want to buy the commodity and not take on all the other risks of management risk and nationalization of the mine, or the capitalization or market risk or dilution from maybe needing more capital? Why not just buy the underlying commodity? And that's why it's one of the reasons why I'm very big or pro the physical metal, because it's probably one of the reasons why the physical metal has done so much better over time than the general mining index itself. Yes, you can certainly hit home runs with certain mining stocks, and David does a great job of picking those. But for the normal investors trying to protect their capital, I think that the metal offers a little bit more, maybe a little bit lesser risk, but it's never going to go to zero. And if silver is an interesting metal because 70% of it's used by industry, it's something that will always be in demand. So that's the oddity with silver, because it's a lot of guys we come at it from a monetary standpoint and an investment standpoint, but most of the market looks at it from an industrial standpoint. And so it has two different components to it.
So Bob, as you mentioned, let's say that piece of news from last week where the LBMA opened its doors seemingly to these artisanal miners, do you think that creates any types of problems for fraud for gold that isn't necessarily gold to come into that system, or do they have lots of safeguards around it?
Well, it's one reason why they may have left out that group, because you're right. There's more opportunity for illegal mines. There's more. Typically nowadays, for example, if you're a U.S.-based refiner buying metal from somebody in South America, for example, you're actually going to send an individual down there to do an inspection on the mine to try and understand, is it the child labor laws? Is it completely above ground? Are they not pulling metal from maybe another mine that's illegal? They're going to try and get more of an understanding of that, and that kind of came about because of the Elemental fiasco, where Elemental, as part of NTR and Ohio Precious Metals, we're buying illegally mined gold, for example, down in South America, and then bringing it back up here, making a fortune. And then basically the company went under, and Ohio Precious Metals, which was a very long-standing refiner, basically went out of business over that. But nobody wants to see that. It's the blood diamond type of concept with like the South African diamond companies, diamond mining. It's a very similar concept. They want to try and keep the business and the metal as clean as possible. And there's been different ways they've been trying to do that with adding chemicals or properties to the metal when they refine it. So then identifying characteristics, they could explore that metal or who refined it. But the problem then is you start taking refiner A's metal and refiner B's metal down the road, and you start mixing those metals together. You just basically mixed two different types of properties in one bar again. So it makes it even more difficult to figure out where the metal came from. There's different ways to try and use the sourcing, but that's the narrative that the LBMA wants to provide, especially to regulators in the US or the Europe or in Asia, is they want to promote a sound investment platform that's not used for money laundering. They wanted to try and promote a better industry. And it's one of the reasons why African refiners and mines have a more difficult time trying to move metal out of certain countries because of labor practices and some of the business practices, and not the most sound places in the world. That's the idea of trying to promote a sound business. It makes it more expensive, though, when all of a sudden those mines that do have, they're above ground and so forth, they're above board in terms of their practices, they're being crimped with higher costs and higher energy prices, and the equipment chain for getting equipment, machinery, and so forth gets crimped because of this globalization lockdown or slowdown. These are all things that I think that's forcing that LBMA to relook at that practice a little bit, try to widen it out. What people may not understand is the financialization of the metals over the last 20, 30 years. That's been the kingpin of really pinching the price or influencing the price more. It's, this active trading of the paper markets that we talked about this at the Silver Symposium a few weeks ago at the end of August, how you have hundreds of millions of ounces of paper metal on the Comex trade in a 4-hour period. It's just a huge influence on the market. And the way these markets are structured, a lot of these, like the Comex, is a seller's market. It's designed to be hedged. And so you have mines that are starting to, as supply starts to drop, there's less hedging that's involved. That's probably one of the reasons why you start to see less open interest. But the issue is, without that hedging, you don't have that suppression or selling of a price, because you got to remember, when silver comes out of the mine, goes to the refiner, then goes to a smelter, or goes through its product chain cycle, it's hedged probably along the way 5 different times, the same ounce of silver. They do that on the Comex. That creates that overly hedged, I guess, or overselling of that same ounce through its life history, and that's why probably the price never goes anywhere, because it's being, the same ounces are being sold over and over and over again. You have that issue. You have London. We talked about the ETFs last week. How the authorized participants interact with the markets, how they influence and make money and arbitrage the spreads between these ETFs. The ETFs aren't really your friend. Client, I think, or the investor is really the product, not the ETF itself. The authorized participant, its job in the creation and redemption of shares, it's designed to make money on the spread between the premium or discount of the shares relative to its underlying value. So you have, Wall Street, or you have the London market, the authorized participants, or the securities desks and so for commodities desks. You have them actively trying to trade markets on a constant day-to-day basis, buying and selling, which is, from a physical standpoint, for a guy like, for people that own the physical model, all that stuff is just noise. They're just making money, every moment of the day, trying to make an extra penny or two an ounce on whether something's at a discount or premium at a given time. But those are all things that influence trading. Now, if silver starts to become tighter, that trading activity is probably going to decline, because you don't have the liquidity that you may have had when you had the LBMA. Silver in the inventories were 1.1 billion ounces. Now dropping a couple 100 million ounces of metal in the last few months. That's going to be less activity there. These are all impacts that start to focus and start to drive the financial markets. And that's where I'm trying to help people understand this coming storm. I think we're going to see is volatility is going to pick up, and the price is going to be going from the short side or the seller side of the market. I think it's going to be going to the buyer side of the market. And the difference is the buyers that are going to be coming in aren't necessarily your leveraged players. There's people that want to actually own the metal because they need to make a product. And that's the big difference that I'm seeing. I mean, at some point, they're going to become leveraged guys that come into the market and they're going to bid it up and they're going to play the options and all that kind of stuff. At least the initial sort of current of the market, if you want to look at like a wave structure, the current at least will be physical buyers that are coming in because they're the ones who are supporting the market right now. I mean, the physical market is very tiny compared to the overall volume in the paper markets. And the physical market has done a very good job of trying to hold and support the markets with this onslaught of selling we've seen really since the summer.
Bob, where do you think those inventories get to before we start seeing either the LBMA or the Comex start to actually act?
Well, David could probably talk about this because he's looked at this a lot longer than I have. I think he was looking at like 30 or 35 million ounces was sort of his sort of line in the sand, I think, where it becomes more stressed, I guess is the word. The problem that the futures market has is it's the idea that it has metal there for a short to actually, well, not just deliver metal too, but a long that actually can acquire that metal. Because you got to remember, hedging also can be done on the long side. And you may be dependent on the ability to maybe get that metal as part of a counterparty transaction that you may have sold, the physical to, and you bought a futures contract expecting to take delivery of that futures contract, say a month out, for example. If that futures contract that metal's no longer existent, all of a sudden that impacts your business or the one leg of that trade. And people may not realize the damage that can be done with that. And that's partly why a lot of money has been moving away from the Comex and going to with these OTC transactions and really doing transactions more with direct counterparties than on the exchange. That's something that David could probably talk a little bit more about in terms of levels.
Yeah, I did talk about it before. I mean, I've seen it get down to around the 30 million level a couple of times, and both times I thought this has got to be close. We got to be close now. And in both instances, the quantity of silver just kind of poured into the exchange, and it went from 30 to 40 to 50. I forget where it went up to, but a great quantity of metal came into the exchange, and I just thought, wow, okay. I don't know where it came from, but you just saw, you saw the big semis rolling in and putting metal on the shelves.
Yeah, and part of it too could be in the past we've always had sort of low lease rates or low interest rates, and now we're coming out of a probably we saw the bottom of the bond market or the top of the bond market, bottom of yields. And so with lease rates rising and finance rates rising, there's less incentive to lease metal to put it on the exchange. And that could be one of the reasons why you're seeing, a lot of this out on the gold side. But that could be something that maybe hampers. The only thing I could think of is if it makes sense from maybe a Contango situation where like we had in March of 2020, when you had this huge blowout between the spot price in London and the New York Comex, where you had, gold go up $65 spread between the two markets. It was worthwhile to take that physical metal, put it on the exchange, and start selling futures contracts to capture that spread. And unless that comes to play again, the problem is a backwardation doesn't do that. A backwardation does just the opposite. You put metal on the exchange and you sell forward, you're actually getting a less of a price. That won't incentivize anybody to put metal on the market. That's part of why you may not see that metal until that backwardation gets fixed. And of course, and that backwardation is part of this supply issue problem that we're having. That's what I'm trying to hopefully maybe make some sense of this and try to help people explain how all this stuff is kind of interlinked.
I want to talk about hedging for a moment, going back to nickel example. So, for a true hedge, if I am a metals dealer and Bob calls me up and he says he's buying 1,000 ounces of silver, I'm not sure his check's going to clear. He's really going to pay me. So I immediately sell on the paper exchange 1,000 ounces on a mini contract. Okay, I mean, everyone can follow that logic. But now think of my palladium example, where the physical market takes control. So now instead of putting up like 10% of the value of that 1,000 ounces, and that's all it took me to hedge, 1-for-1, 1,000 ounces at risk, 1,000 ounces hedged, I've got to put up all of the money because the margin requirements have changed that you have to put up 100%. Well, what if I don't have 100%? Now I'm in big trouble. And that's basically what happens on these shorts that blow up, or either side. I mean, the margins usually get raised on both longs and shorts. Is all of a sudden you're in a cash market, whether you want to be or not. And everyone is so over leveraged in everything. And the most over leveraged commodity, and has been this way for years, is silver. Most of the futures markets are obviously leveraged, but they're leveraged like oil. I think it's only 3 or 4 days inventory. Steve would know, but silver is like months. It's crazy. The worse they make the problem, I think the bigger the explosion is going to be. And Bob keeps telling everyone on this call that we're in a position where everybody's losing now. The primary silver mines, they're not making money. I mean, few are. The retail market's cuckoo crazy with exorbitant premiums. The wholesale market's bidding up to get product. Even the transportation industry, as I mentioned earlier, is taking a lot bigger cut because of the supply chain breakdown and the inventory situation where, I needed the metal yesterday to keep my fabrication going. So it's a mess. And the spot price just keeps going down. And this is going to, at some point, and I know I've sounded like a broken record, but we haven't seen this before. I've never seen the premiums get up this high and stay there. When it happened in 2008, it lasted for a couple of months and then they came back down. This has gone on for months. I haven't seen where the premiums are this high, backwardation, and the lease rates are moving higher, and even the wholesale market is bidding the price higher. I've never seen that before. And at the same time, we're at the crazy low price of, the 18 handle.
I was just going to say, you basically just put the entire thesis of why doing silver right on the back of a business card with that short comment right there.
No wonder everybody's so bullish.
It'd be nice if you could get it at 1850. I mean, you can get close to that off the exchange, but obviously that's true. And obviously it's being drained because that's the best place to do it. So the one thing I guess I should also mention is this game, and I'll call it a game, this paper game works until it doesn't. What does that mean? As long as there is enough physical supply to cover what they absolutely must cover with physical, the game can go on. And that's been the problem in a way, because as I explained earlier, place you really see physical movement is off the Comex. Obviously, we've seen a lot of it, since Silver Squeeze started. But normally, it moves in and out, of course. But a lot of that movement is really a tag that moves from a big set of bars to another set of bars across the aisle with somebody else's name on it. A lot of that stuff actually static, and the movement is just a bookkeeping entry. So, but now that's not the case. You're seeing actual metal leave the warehouses, and that's, of course, what we want.
David, I was going to ask you how, I don't know exactly where to start here, if we should talk about lease rates being very indicative of demand, if we should talk about 1,000-ounce bar premiums. Where do you think is the most appropriate place to look for that stress?
It's the lease market, I think, and here's why. When Buffett bought the 130 million, it's 129.7 million ounces of silver, basically that whole thing came off the Comex. Now there's rules in place. You can't take that much. So when it happened, the Comex delivered 90 million ounces. That left 40 million up in the air. In other words, they owed him 40 million, and he just kind of backed off. Lease rates went to around 17% and stayed there for about 2 years until he got his 40 million ounces. Then they came back down. He shipped all of it to London. So there's 130 million ounces under the care and maintenance of JP Morgan. And lo and behold, the SLV started out of London with 130 million ounces. I'm sure it's all just a coincidence, but that's what happened.
So then where do 1,000-ounce bar premiums come in to your thinking on this market tightness?
Well, it comes in of supply and demand. I mean, I hate to keep using the same words over and over. It's that I need silver regardless. Of course, that's the industrial side primarily. But as Bob said a few times earlier, I want silver regardless. I don't care if it's 1,000-ounce bar, a kilo bar, 100-ounce bar. As long as it's 999, fine. I'll take it. So this is what's happening, is that there's only there's an outfit, I forget their name, that I think they're taking 1,000-ounce bars and sawing them and weighing it out and selling bars that have been cut up off the exchange. I mean, this is what happens at the end of these bull runs. And it's not the end of a bull run. It's just the beginning of an explosion. But this is what happens when the markets get very distorted. Weird things take place. So it's just indicative of there is a demand that cannot be met and the price is wrong. It's just plain wrong. Unless the exchange basically moves to try to balance the market, instructing the participants in the futures exchange and say, look, we've got position limits and we haven't been paying attention to them. They're now going to be enforced starting, October, the December contract, from the December contract onward and all through 2023. But I don't think they'll do it. I really doubt they're going to do anything. Bureaucrats are usually good at watching things explode. And after they explode, then they have to blame the public. And after the public is blamed, and the nasty speculators, like the people that listen to David Morgan and Bob Coleman and SRSrocco, Steve St. Angelo, and Butler and Ed Steer, and I mean, we'll be taking the blame for it. There's no doubt.
I hope that's a good point.
I hope not.
Guys, we had a question come in here. He said, "Can you ask Bob, how does the premium on constitutional silver inform how you think we should be thinking about the investment flows into physical metal?"
Well, the constitutional or junk silver, that's the pre-64 quarters, dimes, half dollars. That market has become, it's much smaller. It's not as dominant as it was 20 years ago. Yeah, it's a total supply demand driven market. It may give you a guide for interest in the market. Like, for example, when it's, you used to look at it and trade at $1 or $2 premium over spot, and you're thinking, okay, well, people have a lot of interest in silver because that's sort of indicative of that. But now it's getting to a point where there's a lot of interest. There's just not a lot of product. Nobody's really letting go, especially with silver at 18 or 19. I mean, they weren't willing to let it go in the 20s. They're not going to let it go now. And I think this is an important note with the constitutional silver, along with other products as well. And we talked about it before. The 2017 Tax Act that Trump was passed and Trump signed off on killed the 1031 exchange advantage for precious metals, meaning you could swap out of one silver product for another silver product and basically roll your cost basis into that new silver product. So you could, in a way, you could create some arbitrage for yourself. And for example, for example would be, Silver Eagles trading at $15 premiums, and you want to sell your Silver Eagles and buy a 1,000-ounce bar for 90 cents over spot. You could capture a lot more ounces that way. Well, now that becomes a taxable transaction, and that's something that it's sort of a hindrance to the market, because if we would have had this 1031 still on the books, this exchange allowance that we could do this with, I think you would be seeing premiums not as high as they are. I mean, that's one factor. The other factor is there's a lot less blanks being made today than there was 10 years ago. I mean, there's a lot more physical Silver Eagles that were made in 2011, 12, 13 than there were in the last couple of years. So some of this massive, we look at demand. If you look at it from a price standpoint, premiums have ramped up, and that's kind of, the premiums are double or triple. Of course, now they're just real much more versus they were back in 2011 and 12 during that time frame. But there's just less product being made, and that's creating the distortions, and for a refiner to get on board to make, a major refiner to get on board to start making blanks for the U.S. Mint and meet the fine requirements that the Mint has, very strict requirements, to put that plant into place and all the equipment and to get it up and start to make product, you may be 6 months to a year away, and that just adds, and that's if premiums stay high and incentivizes that blank maker to continue to maybe get into the business of blanks. I mean, what happens if silver goes during that year's time, goes from 18 to 50, and now all this metal is coming back onto the market, and premiums drop like a rock, and no one's buying the physical market, the brand new product anymore, and they're only buying the secondary market because it's a lot cheaper. I mean, you could run into that issue too, and we saw that happen, especially after 2013 when you had the break in the market and product became very still. The volumes really dropped off. So when people started selling, the secondary stuff was being bought because it was being bought at a lot cheaper price than, like what the authorized participants, when they were buying from the Mint at $2 over spot for Silver Eagles, they were selling them for $2.20 or $2.15 over spot, just basically breaking even between their logistics costs and the cost of the product. They were barely making money. Whereas if you could get someone selling secondary product back to that same wholesaler, they were maybe buying it back at $1.75 over spot, and then they could make more money that way, or they could offer that secondary product at a lower price. Those are all dynamics that need to be explained to the public better, not just simply this one-line mantra of, oh, we're going to have shortages, so you got to buy the product at any price, and because you're never going to get it if you don't buy it from me. And there's no metal available, but I have plenty in inventory, and I'll sell it to you. To me, it's being very misinformative to the public, and that's where I'm trying to add a little bit more voice and light into, from an investor standpoint, how to maybe protect themselves and how to educate the public and what to look for, what questions to ask. Not just simply to take for granted what a gold dealer tells you, because maybe that's a conflict of interest because they're just trying to move inventory. That's their job, is just transactions.
Bob or Tom, do you mind if I jump in? Because Bob said some very interesting things, and he's correct. I do want to clarify some issues about the coin market, the coin and round market. It is true, back in 2015, the United States U.S. Mint sold nearly 50 million Silver Eagles. And Canada, I think the Canadian Maples were like 35 million. Total coins that year, total coins from all official coin makers around the world were less than 140 million. Last year, it was 154 million. And this does not include the rounds. And it's in the last 5 to 8 years, there's been a substantial increase of people buying rounds because of the higher premiums. And so those who make the blanks for not only the round market. Again, rounds are not official coins made by government mints, like the Silver Eagle, the Silver Krugerrand, the Silver Maple. These are private mints that make, like the Buffalo round. And so the real issue isn't that there's less rounds. There's just a lot more demand for the rounds and coins. So if we understand, last year there was 154 million coins, and we saw a huge increase in production from Austria, from South Africa is now producing a lot of Krugerrands. Geez, you go back about 4 or 5 years, they weren't really producing hardly any Silver Krugerrands. It's a new product now. And I imagine they're going to be at 15 million or more this year. So when you add up Canada, the United States, Australia, all these different countries now, and then you add up all the rounds that are being made, it's probably going to be upwards of 170, 180 million ounces of rounds and coins that are being purchased by investors. And so I think this is another issue. There's only so much capacity to make rounds. No one's going to invest a bunch of money because it's kind of fickle, the bullion market. It's feast and famine. And so again, I actually don't believe there's less rounds being made in the world. I think there are more blanks being made. There are more blanks being made in the world today than there was 5-8 years ago, even though, and it's impacting the supply that the U.S. Mint can get. And there's other issues involved as well, but I just wanted to add that because it's important. Investors now are buying record amounts of official silver coins and silver rounds, the most ever. And this is another issue that's feeding the premiums.
Yeah, I'd like to add a little bit more. I just toured the Sunshine Mint down in Las Vegas. I think it was about March. I was at the 121 mining conference. I had to sign an NDA, but everything Steve said is accurate. And I'll just add that if they had the capability to produce more than they already are, and it's very tough working conditions. I mean, it's very hot in the building, lots of noise, but they're going full strength, double shifts, pumping out as much metal as they can in different forms. And if they had the ability to do more, they would. So they're basically at capacity, not as far as capability, but as far as workforce that they can keep at the machines. So there's that. And then just one other comment on the first part of the question about the constitutional or junk silver. That's a subset, and it's really a fear market. The Y2K is a perfect example. The bag market got about a 40% premium right before the Y2K rollover. And the reason it got such a huge premium is people wanted that specific product. Why did they want that specific product? Because it's a barter item. It's easily recognizable. It's U.S. coinage, and a dime is worth whatever the market will bear. And once Y2K rolled over and nothing happened, the computer stayed up, and the bag market came back down to normal premiums. Now it's a function of just the supply and demand are so little. Most of the bags have been melted down. There's very, very small supply of bags relative to what it used to be. And the bag market ended in mass years ago. When I started getting serious in the silver market, there were two markets on the commodities exchange. There was a silver bag market and a silver bar market, the one we know now. And there was some arbitrage that could be done between the two markets. A bag is generally melt value of 720 ounces. So $1,000 bag, 1,000 coins for dollars, for example, is worth 720 ounces. So you could do the math, but there was some arbs that went on between them. But the bag market got drained to the point where the exchange was down and the bag market went away a very, very long time ago. And one anecdotal story I'll tell you is if you read Silver Bulls by Paul Sarnoff, he explains in there that one time that the Hunts were taking delivery, the exchange couldn't meet their delivery. They said, well, we can't make it. And so now Hunt basically had them. But they asked him if he would take bags in lieu of bars as delivery, and he said he would. So he could have said, no, the contract says bars. I want bars. You can't deliver. What are we going to do about it? But he didn't. He took bags. So I'll leave it there.
Thanks for adding that, David. And Bob and I have had this conversation before about kind of how interesting the constitutional silver can be just from thinking about it from a historical standpoint. But maybe you guys could weigh in a little bit on, let's say, best forms of silver to buy. Are we only going after, let's say, forms of silver that carry the lowest premiums, which if you can afford, let's say, 1,000-ounce bar, is that one of the better ways to go? What problems do you see? Let's say pros and cons of maybe constitutional 1,000-ounce bar, or maybe a sleeve of maples or eagles.
Well, I'll start out. I mean, it's personal choice, but I've always recommended or used to starting off with junk silver or constitutional silver because in the worst case, it is barterable. And it also used to sell sometimes at a discount to melt. Many times it had sold, basically you were getting silver at basically no premium. It's already minted. That's not true anymore, obviously. But I think you should start with coins first because you have, if you have a 100-ounce bar, you got to, and let's say all you can afford is 100 ounces or 1,000. If you have a 100-ounce bar, you got to make one decision and it's got to be right. If you have 100 ounces in 1 ounce rounds, now you got 100 choices. I mean, you can sell one at a time, sell 10 at once, sell 15, whatever. So I like the diversity, plus the idea that you don't have to, make that one decision. So I tell people to start with coins. And once, if they're, big stackers, then move to bars because they're easy.
Well put, David. I like your thinking on that. Bob, do you have anything to weigh in on there?
Yeah, I mean, it gets into some interesting, I guess, debates, I guess you could say, because you have in the business now where dealers are trying to sell proprietary products with their name on it, so to speak. And you want to be careful with buying proprietary products. They may be at a little bit better price, but try to shop around. I tell clients, try to get primary brand name products because you can take those products to a local dealer. They're going to recognize it. You can sell it to any retail dealer online or, maybe your local coin store, that type of thing. Especially if you're international as well, it's much more recognizable. And that's what I try to do is try to stick with LBMA type brands or large brands like Royal Canadian Mint or Pamp Swiss or Johnson Matthey. And try to, when you get involved with proprietary name stuff, then it's really the dealer that's selling that product is one that's going to probably give the best price when you go to sell it. The problem is how well capitalized is that dealer. They may have made a bunch of product because they were able to make a fat spread on it. And then when it comes time 2 years from now and everyone starts selling to them, they may only be able to pay so much because they're going to just sell that metal to a wholesaler or back to a refiner, and they're only going to get melt minus some kind of discount. So you want to be careful getting too trapped in a product possible. Now, of course, with the tightness of the market, you don't, beggars can't be choosy, so to speak. You don't have the flexibility to get the perfect product. I mean, like the Eagles, it was always a go-to product. It was recognizable. It had a lot of benefits being a U.S. Mint product, especially if you lived in Arizona or Utah, for example. There's no state capital gains tax on those products, but their premium is just outrageous. So it doesn't make much sense. There's really that justification, even from a tax standpoint, to get that product. So understanding that dynamic kind of helps try to narrow down your selection. If you buy sovereign products, the advantage is they're recognizable. It's the problem is the premium right now. So if you have to buy, I try to tell people, listen, the bar market is a lot cheaper. I have today we were just I think it's 325 over spot for silver Pamp kilo bars. My wholesaler basically just they're live now on the shelf, so to speak. So that's actually completely available. But that's something that at least you're not paying $5, $6, $7, $10 over spot for a coin. You can get into a bar. And the spread risk, meaning if premiums start to fall back or secondary product comes back on the market, you probably have less risk on a $3.25 premium on a bar than you do at a $10 silver sovereign coin, like if it's a Canadian Maple Leaf or something of that nature. So you want to kind of factor that into your budget. The issue with 1 ounce rounds, especially with IRAs, you want to make sure who's making that 1 ounce round. If it's, say, either a Comex approved refinery or it's an approved refinery via IRS standards, so that metal's eligible to be held in the IRA. It's another reason when you buy metal in an IRA, it's one of the reasons why you don't buy metal that's not IRA approved, because the wholesalers, you just lost half of your market when you have a metal that's not it's made by a refiner or a private mint that is not available to be put into an IRA. You've kind of cut out some of that market share. It's something to be cognizant of at least, because it's, your premium on that product may be a lot lower than you would on maybe a primary brand name bar. I mean, you have to think of this as an exit strategy, that if you're right and buying the product, you're right on the price goes through the roof. Everyone else that's in the market is going to be trying to sell at the same time, or they'll probably be, scaling out of a position, taking profits, maybe not moving to dollars. They could be just moving into, like David mentioned, paying off debts or buying a house, or maybe going into the stock market, because from a relative value standpoint, maybe the S&P 500 is cheap relative to the precious metals. Who knows? But there's going to be a lot of transaction activity that's going on. You want to make sure that you're not putting yourself in sort of a position where now you're having to make back a fat premium. And then on top of that, the spreads start to decline. And then all of a sudden, maybe you're in a product that's a proprietary name product, and it's not being supported except by that one dealer. And all of a sudden that dealer is overloaded with selling pressure. Those are factors that you have to start thinking about as an investor. Now, maybe if you're buying the metals for the idea of handing it down to your kids or grandchildren, that's not a factor. That's all you're doing there is you're just, you're putting it away for estate planning purposes, and you're letting the heirs take care of that issue. But that's just that's one factor of many to look at when trying to select product.
Perfect. Thanks, Bob. Did you have something to add there, Steve?
Yeah, Dave and Bob put out some excellent information on the details of what different products to own, and I agree with all that information. And so I like the KISS, keep it simple, stupid principle, and it really comes down to what kind of investor you are. If you're a small investor, or let's say you want to invest a little bit to get silver, this is your funds. The best thing, as David mentioned, is the coins, and probably the official coins with the lowest premiums, because they're well known in the industry. And so that's usually the good start right there. And now, if you are a larger investor, medium-sized investor, it's good to have the coins, because who knows in the future if silver is going to be needed for some kind of barter or trade. Or if you want to sell silver, you don't need to be selling large chunks. You want to sell smaller pieces. So it's good to have the coins. The next thing, if you are a medium to large investor, then you've got a larger amount of money. And so buying thousands of coins with higher premiums isn't the common sense thing to do, because you're not going to store this underground. Well, maybe some people will try. But if you're a larger investor or a medium investor and you've got more money, you're probably going to buy the larger 100-ounce LBMA Comex approved bars that are well known. And these are going to be held maybe in a private vault somewhere. And so this is how investors should be investing in silver, starting off with coins if you are a small investor, and then gravitating if you want to invest more. Some might want to invest in gold, but if you want to invest larger sums, the wise thing to do is really not to go to the 1,000-ounce bars. I mean, you can, but it's probably wise to go to the 100-ounce LBMA Comex approved bars that sell just as easily and have very low premiums than trying to sell 1,000-ounce bars. So that's all I want to add.
One of the things I'm trying to do is educate institutions to get into the physical metals market. And we've talked about this concept of institutions entering into the precious metals world, where they're kind of prohibited from getting involved in the physical metal via the charter of their investment document or their registered investment advisor or investment company, and they can only invest in funds or securities. So that basically wipes them out of the ability to get into the physical metal, or they just can't get physical metal for their clients because they can't charge a management fee on physical metal. They can only charge it on securities and funds, so that's why GLD is very, very popular. SLV is very popular. I think it's important from a larger high net worth individual, an institutional level type investor, to consider the physical market for a number of reasons. One is the counterparty and systemic risk issue. Obviously, seeing volatility in the general financial markets. The issue is what happens if we do have a silver crunch. How does that going to affect all these structured products? And we've gone through these structured products in past spaces of, some of the stuff is just complete. It's designed by Wall Street, priced by Wall Street, and benefits Wall Street. It doesn't really have much benefit for the customer. It's just like the Big Short movie, where the guy wants to buy the contracts, to bet against the housing market, and Wall Street's laughing in his face when he's handing over the money. It's the same concept. But with the institutional investor, I think it's interesting to look at the physical market because it trades 24 hours a day. It's very liquid. Maybe Saturday and partly Sunday it doesn't trade, and Friday night it doesn't trade. But it's very liquid and deep. And the advantage of moving metal, like we take metal off the Comex, we've taken delivery of product from programs around the world. It's not as difficult as what people think. It's not as expensive, especially when we're dealing with larger size of shipments. You're talking cents per ounce, not necessarily dollars per ounce. And I think that's a big factor because everyone looks at the SLV as, hey, listen, I can get in and out of this thing. It's a great trading vehicle. Yes, from a day-to-day perspective, you can get in and out. There's very low friction costs. But if you're really an investor trying to say, listen, I'm high net worth investors or family offices are trying to maybe plan for 5 years down the road in terms of, hey, maybe what happens if tax structures go up? Is there any benefit to having money in a fund? And then when I pull it out of that fund and take delivery, that's a taxable event at that point, when in fact, all I wanted was the metal in the first place. For every fund, there's a great salesman to it. So you got to kind of see through and understand why you're buying like these closed-end funds that are very popular with some of the silver crowd held up in Canada. I'm not going to mention names. That's one of the issues is if you ever want to take delivery of that metal, it's a taxable event. And buying the physical, you already own it in your name in bearer form. It's private property. It's a huge advantage for the institution, and it can unload it anytime they want. Moving these metals, logistics, we that's what we get involved with. We have shipping policies, transit policies for all that type of stuff. It makes it much more inviting for an institution to get some real participation and end up reducing, the other forms of risks, besides counterparty risk, getting authentic metal and the conflict of interest that comes along with, getting into a structured product with the issuer is also the price setter. You're getting more of a real product in a market. I think that the physical product is going to start becoming more of the price setter. I think that's a dominant theme that institutions should try to look at when considering silver or gold as part of their portfolio.
Bob, earlier you mentioned the banking regulations that changed, the Basel III regulations that aren't necessarily familiar. Can you give us like a 2-minute overview on that and why that was, let's say, a good or bad thing, depending on which way you look at it for the markets?
The Basel III was something that looked more at more their structured programs that they offer with the unallocated account. It was really focused on the leverage factor that the bank's balance sheet takes on. And you have to understand when it came to gold and silver, the unallocated program is very popular in London. And the reason why is that, say I'm a customer of the bank and I want to buy some gold, and I go to the bank and they say, well, you can either buy the physical bars and have it allocated in your name and held, the specific bar numbers, or we have product B behind, door number 2 with no storage fees and no cost to get in, no cost to get out. But what you're doing there is you're buying a service. You're not buying an actual metal. So with unallocated programs, they're backed by the bank's balance sheet, not necessarily by the banks by any underlying metal. So when Basel III came out, basically said that if you're going to offer a program like that, you're going to have to fund it with 85% capital. So in times of stress and the client wants to pull metal out or pull their money out, you have some type of asset backing that. It's not just simply the bank's balance sheet that's already levered to the hill anyway. So that's maybe, if that kind of helps, a little bit of a thumbnail sketch, at least on the bank level of why Basel III had some importance, and that started this deleveraging event that you're seeing happen, where banks are now not as participating in the market as they used to be because they don't have the incentive to. The trading desks have been moved from the commodity side to the equity side, and that's why you see a lot of the authorized participants. Now the ETFs have become so popular. Well, it's an easy business to run. You don't have the borrowing and interest expense and the risk and the margin calls and the sudden events that change in the commodity markets. Now you just simply run a fund and you're making money, or you're an authorized participant making money on spreads of, hey, is the fund at a premium or discount to its underlying any given moment of the day? If it is, I'm going to try and take advantage of that quick arbitrage and do that over time. And you throw a computer program onto it and it makes it that much easier. But that's partly how the industry, that's how it's kind of unfolded here. It's just, and that's why there's less participants involved. And I think that's why the market's going to become more choppy, more volatile.
Perfect. Thanks, Bob. We had a question come in when you were talking about, we were kind of discussing medium to large size investors. I believe, David, you were speaking to that. What dollar amount correlates to medium to large size investors?
Did you want David or me? Or
I think David was talking to that, but if he's busy, then maybe give your stab at it or your thoughts too, Bob.
Yeah, I mean, we deal with clients, from that buy 500 ounces of silver to, millions and millions of dollars worth of silver. I mean, it's metals. I mean, our depository, we have a $500 million all risk policy. We're one of the largest private depositories out there, especially I think we're the only depository that's not owned by a gold dealer, financial institution, or cash in transit company. So we don't have any of that transaction business that creates that conflict of interest. We're simply a storage depository. And then under my registered investment advisor, I have a subsidiary that buys and sells metal. So I act as a purchaser representative, not necessarily the dealer. And that's sort of where how I basically am able to get a lot better prices is that I don't need to carry this inventory. The wholesaler is basically who I go to when I need to buy. And so it makes it simple. It keeps me extremely competitive in the market. It's how I'm able to beat most of these dealers out there. There's nothing wrong with the model. It's just that the only downside is I'm not taking live inventory and adding carrying costs to that, which marks up the product a little bit more, and then the client ends up paying for that markup as well. To me, it's trying to, again, create the avenue for the client, whether they're small or large, to get the best price possible. Now, in terms of medium-sized clients, if you're buying, $50,000 to $100,000, that's probably, say, medium-sized client, and then of course you get six-figure and larger size orders. 10,000 silver, that type of thing, $1 million trades. I mean, those are larger size clients. And what you've been seeing really consistently since 2019 is the larger size client has been coming into the market consistently and buying on a consistent basis. They're not just simply sporadic. They're actually, and they're buying not just simply say, hey, listen, I think the price is going to go up in the next 6 weeks. They're really buying for the long term, even for estate planning purposes, that they may not even let go of this metal. They're just going to hold it and pass it down. I mean, it's a very different motive that you're seeing in the market now because of the debt servicing needs of the U.S. government, the over indebtedness of our financial system, the leverage that's been placed on it. There's countless reasons why metals are more appealing now than they ever were before. But it's odd that the sentiment is as poor as it is in that same time frame. Yes, gold and silver have gotten a bad rep as an inflation hedge this year. I mean, in all honesty, walking into this year, and I would have told you we're at the highest inflation rates in 40 years and the best performing asset is the US dollar. I think all of us would probably shake our heads on that one. The market just tends to unfold. Sometimes it does what you expect it to do just when you least expect it. That's something that I've learned from an old broker a long, long time ago. And so that's why you got to have time in the market when you're dealing with the metals. That's the tough thing with miners. I think if people are constructing portfolios, they should probably consider the physical metal first as a core portion of their holdings. And then as they fill up that basket, that allocation, they may move to miners as sort of a speculative side. There's going to be a lot more volatility there. There's obviously a leverage factor and potential upside factor, but also at the same time, as you're seeing, these things can stay dormant and ultimately either need more capital, which becomes dilutive, or ultimately get delisted or absorbed into another company, and then you may have a permanent loss there. But those are, hopefully that kind of helps a little bit in terms of maybe how to look at the metals as a portfolio standpoint.
Yeah, thanks for sharing your thoughts on that. We had another question come in that said, any thoughts about Brics move into a commodity-backed currency and its potential impact on the global monetary system and the precious metals market?
Well, I'll hit that one for a minute. First of all, anyone that went to,
David, maybe before, sorry, just to interrupt you real quick. We had just asked, and I think you were speaking to that, when you were talking about medium to large size investors, just to get your 2 cents on what you meant by
Bob
medium to large.
Well, there's no real number, but I'd say if you're 25 to 50,000 and up, you're a medium to large investor, the way I'd see it. On the anyone, if the Brics go to a commodity backed, system, especially if it's tied to gold, then it would disrupt the market, or certainly has the potential to disrupt the market. However, my take at this point in time is that that's more of the Hegelian dialectic, where we've got the problem, reaction, solution. They're giving us the idea that they'll go to that, but that's really just part of the plan to divide it. The reason I say that is if you listen to my crypto conspiracy series, it's number 24, I interview a guy named Kent Lewis. He'll be speaking at the Red Pill Conference as well as I in Salt Lake City, November, I think it's 12 and 13. You can look it up. But he went through a lot of information that we posted during that interview that shows that the agreement between the Brics and the banking establishment is already set, where the Brics are willing to go along with the new system. So data looked like it was legit to me. You can check it out for yourself. You can go to Crypto Conspiracy number 24. But it could be a red herring. And I was, just until I interviewed Kent, I was believing or thinking that the Brics were really an alternative to the Anglo-American empire. In other words, it was an alternative to the U.S. dollar-based system, or the hegemony that the petrodollars had forever, since 1971. And I'm not convinced of that anymore. So I'll start off with that, and I'll hand it back to you.
Interesting. So it's not necessarily the currency, but it's what it's backed by, or can you elaborate on that a little bit more, David?
Yeah, the way it's written, it's that regardless of what they do, it wasn't specified they wouldn't have any commodity tied to it. It's just that they will be in the overall global currency system. That's what it really said. So you could say, well, if it's gold backed, isn't that wonderful? But if it's part of the global system, in other words, we're basically looking at a one world currency eventually, and a capitalist system. If you read this document that I show during that interview, it alludes to the fact that that's fine and dandy with the Brics. They're willing to go along with it. Okay, but it didn't specifically say, we won't be, that there could be an in-between phase. I mean, you can make some conjectures that because they signed the agreement. I mean, we signed an agreement and didn't obey it. I mean, I don't want to go too far down the rabbit hole, Tom. All I'm saying is I changed my thinking on it. I was thinking that there was really an alternative that the Brics were putting together. And now I'm not so much convinced that's true.
Yeah, I appreciate you sharing your thoughts with us there, David. Bob, do you have anything to add there?
I try to stay away from some of that stuff because it's so far out in terms of, impacting, maybe the next year or so type of activity. I mean, it's especially with, the Ukraine thing popping up. There's a lot of ways that obviously Russia is trying to be able to move gold, maybe to liquefy that through back channels, and so they'll put out different news items that kind of gets the gold bug community kind of roused up. But in reality, I saw an interesting chart with Turkey, and the importation of gold that's going into Turkey is just incredible. And yes, they're experiencing very, very high inflation, but you almost wonder if a lot of that gold could be, maybe some Russian gold, that they're trying to use to try and filter through the system and try to liquefy. But of course, we saw Russia talk about how they may be done buying gold for a while, and I think that's partly because of these capital controls that the Western world's trying to place on them and try to restrict that flow of metal. So some of these they're just too longer term events, I guess you could say, that maybe it has a 5-year, 10-year type time horizon. But by then, I think if gold goes to $3,000 an ounce, all of a sudden the U.S. government says, okay, we're going to back our currency with gold again. There's no reason to own gold anymore. I mean, your currency's backed by it. I mean, anything could happen down the road. I just try not to factor some of this stuff. It's just too far out.
Very fair. It was a pretty informative space here, guys, and I appreciate your time. But yeah, I think we can wrap up this evening. Thank you, gentlemen, all your hard work and always being so generous with your time and with your opinions.
Thanks, Tom. Thanks, David and Bob, and all the listeners.
Yeah, I appreciate it again, and definitely. People want to hear more of these. Just let us know. I'm up to try and help people educate. There's a lot of discussion and topics that we could get into, and Tom knows I've been on these calls sometimes 5.5 hours, which I think are too long. But we can certainly get into other topics if people have interest in it.
Yeah, we've certainly had some very lengthy ones, Bob, but it's always good to kind of maybe jump down the rabbit hole a little bit. But we're not here to fight about Bitcoin versus gold or silver or whatever. I think at the end of the day, they all, in some ways, play on the same team, and I think if anybody says they have a perfect answer to who's going to win or what asset class is going to do best, I think that's where you have to become skeptical.
Yeah, I try to stay away from the maximalist type of idea and mentality, but just trying to keep a open mind in terms of, from an investment standpoint, where the best value is at any given time. And right now, to me, obviously, the metals make a lot of sense to me, even from an investment advisory standpoint. It's one asset class that, especially silver, has not performed really at all relative to the stock market, since 1970. So it offers some interesting value there. But yeah, anytime we can do these, anytime I'm up for it.
Excellent. Yeah, thank you, Tom, for hosting. Thanks, Bob. And thanks all listeners. Hopefully it was of value to you.
Thanks, everyone. We'll try and do one of these again in the next couple weeks. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.